Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, March 7, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. So today the market is doing, for the most part, as expected, meaning working its way down to the gap fill at 236.50. We should have hit it today, but we didn't. And the main reason, in my opinion, is the light volume. With light volume, it's very, very difficult to get any kind of selling pressure underway in the market. And therefore, the path of least resistance is to the upside. So we did see a little bit of late selling pressure today as the market was coming to a close. But even though this morning the market was down, we couldn't get there, and the market did bounce and basically traded in a very, very narrow range for the majority of the day. Let's go down to take a look at a shorter time frame just to see what we're looking at from an intraday perspective and what to expect going forward. So you can see here the market gap lower a little bit and made a low here around 10:30 as it normally does, and this was 10 o'clock, and we bounced lower, and we basically traded in a very narrow range for the remainder of the day. But what this was a bearish pattern that was developing. So when we go over to the hourly chart, okay, and we take a look, you can see here that the market was basically trading in a bearish pattern, meaning sideways after a down move below the moving averages. That's bearish, and therefore the market did have that late day sell, but still coming up short of the 236.50. The way I see it is we're either going to hit the 236.50 or lower into the morning hours tomorrow, or potentially, and they've done this before, they could do it in the overnight session. We can wake up tomorrow and the market could have already satisfied that, technically speaking, in the futures market, and that could be all she wrote. I'm not saying that will happen. I'm saying that can and has happened. Let me just give a quick little refresher on a little chart pattern here and what the expectations should be for anybody that was looking for the 236.50. So when we're trading in a bearish pattern above that level, 236.50, and it was close enough to that level consolidating on the hourly chart where it was going sideways for 4 or 5 hours, when that happens, if the market were to come late today into that level, you really would be looking slightly lower than the gap fill because of the consolidation above that level. So for example, if somebody was looking to play the market long at that level and we consolidated for 4 or 5 hours all afternoon above that level, what you're really looking for is lower. For example, like down to 236. And that would have been a better level to trade as a result of the bearish pattern that developed all afternoon long. So what I'm saying is, right here, when the market trades sideways above a level for a period of time like this for the majority of the afternoon, you really want to look lower, because out of this bearish pattern, if the market were to come down with any kind of a heavy sell, then generally speaking, you would not necessarily stop at the 236.50, maybe for a candle or two, but generally you would find the market ultimately trading lower. So let's talk about where we're going from here. So let's go back to the hourly chart, and I've got some other lines on the chart, some other numbers, and I've taken a couple off. So let's just review what we've got here. So tomorrow, on Wednesday, is day number 6 from the most recent pivot high all the way up here on the 1st of March. If we're to fill the gap tomorrow or slightly lower, we could trade down as low as 235. I have 235.06. That's another gap fill area, and I can show that to you on the hourly chart. You probably already saw it when we were on it before. But here's that gap fill on the hourly, 235.06. So that would be another level if we did put in a decent sell with selling pressure tomorrow. At this point in time, it's hard for me to see the market selling much more than that. But if it did, and just because I don't see it right here doesn't mean it can't happen. I just don't see it happening below that tomorrow, but it certainly can happen. I think slightly below that gap fill at 236 will still provide a fair amount of support for the market. But if I'm wrong and we do sell farther, then the 235 level is another level of importance. And if it's really a bloodbath, or whether it's tomorrow or beyond, if we continue selling, then below 235, I think then we trade all the way down to 232 and change. 232.34 is a 2.5 retrace from low to high, and the low meaning the low down here. Let me draw it in. Here's this low to this high. A 2.5 retrace is down here, and that would be another level of support. I don't necessarily see that happening, but it is a possibility, and therefore I want you to know the numbers as it relates to what's possible. But again, as I've been saying day in and day out, wherever this decline decides to stall out, it's going to be nothing other than a pullback, and there are higher prices coming. We still have higher prices in this market. I still believe we will hit the 246 in the spider before any meaningful correction occurs. What we're seeing now isn't a correction. It's just a pullback working off some overbought condition, and in my opinion, it's about done or close to being done as we speak. All right, so that's about everything I know as it relates to the spiders. Let's move on to another market, and that one is the IWM. So while the spider was down about 1/3% today, the IWM was down 0.75%, and therefore, again, leading the market down. The IWM will typically lead the market in either direction, either on the downside or the upside. We came into the 50-period moving average, and that was all she wrote on the downside today for the IWM. The bigger picture, there's nothing wrong with the bullish uptrend in the IWM. We're just working off an overbought condition. We're having a pullback, nothing more, nothing less. Any further sell in the IWM will find a lot of support in this area here. All this chart vibration in here, okay, this is consolidation or chart vibration, that will act as a safety net for the market. It is a support area. And how do we know that? Well, we know that because the market is telling us, by virtue of these pivots here, okay, it's telling us that this price level in the market is important. So anywhere in this neighborhood is an important price level for the market, therefore will become supportive of the market once again if and when we do get down there. Even though the market would find support at these areas, if we did sell through there, then we have another gap fill down here at about 131, and that would also be a fantastic level of support for the market. How do we know that? Well, if you look at the fib levels on the chart, you can see here that the 2.5 retrace comes in at the area that I just mentioned that would be supportive of the market. So there's a secondary reason why the market would find support at that level. And then, ironically enough, and there is no irony here, it's not an accident, but the 382 retrace comes in at 130.94, absolutely spot on to the gap fill just mentioned. Again, not a coincidence. Now, that gap fill occurred on, it occurred on December 2nd. The high, the pivot high that we used to draw in the fib retraces was made on March 1. So the high had nothing to do with this gap fill, although even though the 382 retrace comes in at the same level, it goes to show you the power of the numbers. The market is mathematical, whether folks want to believe it or not. The way these things work out is not a coincidence. It's not an accident. The market trades to certain numbers. You can't always identify them until you have pivot highs and pivot lows. However, once you do and you see that the market happens to be a 382 retrace right at a gap fill, you know that if the market comes into that area, if the IWM comes into that area, that will be a support level come hell or high water. I don't see us getting there right now, but I thought it was worth mentioning at any rate, pardon me. Something else worth mentioning, we'll bring up the VIX chart tonight. And you can see even as the market has been selling a little bit, there's been absolutely no movement in the VIX. There's no fear. The VIX is below the moving averages. We haven't rallied at all in the VIX. And that tells you there's no fear out there in the market. Now, you can read that as in one of two ways. Either there's no fear, the market's going to bottom shortly and resume the uptrend in short order, or there's no fear, and that also is in part a recipe for more selling, right? The more bearish people are, the less likely we are to sell. The more bullish people are, the more likely we are to have a selling episode because it's unexpected. So it's counterintuitive. However, I think it's the former, not the latter. I think that this is just a pullback, readying for higher prices ahead. It's interesting nonetheless. When we go over to the transports, we did see selling pressure in the transports today. Didn't quite make it to the 50-period moving average, but the transports were down over 1%, which is a decent sell for the transports. So again, our two leading indicators were leading the market on the downside today, the IWM and the transports, and they're pretty tried and true, so that's why we continue to use them as leading indicators of the market. We should, at a minimum, hit the 50-period moving average as one more leg lower, even a small one at that, is expected in the overall market. However, when you look at the transports, you can see there's support here, support at the 50, this pivot and the 50, and you had a breakout here. That's another reason. You had some pivot highs. You had another pivot high here. That's telling you that that price level is important. Okay, you had consolidation here. You had a little consolidation here, a little consolidation here. This market should be, or pardon me, this level should be supportive of the market. If it wasn't, you have the same thing going down in this area. Okay, you have support either slightly below where we are or down at the $9,000 area on the transports. Okay? All right, let's head over to the gold market, and we saw a little bit of a sell today in gold. And you'll remember from last night, we discussed getting below the $1,225 level would bring us in pretty rapid fashion down to the 50-period moving average that comes in around 1209, and that's where we're headed now. Maybe slight pierce through that. We could go all the way down to 1200, but that would be a normal garden variety retracement from the pivot low to the pivot high. And the pivot low being here, the pivot high being here, and this is a garden variety retracement, completely expected and normal market activity. We're also hovering right above the 382 retrace. That's where we stopped today on low, just a couple of dollars above the 382 retrace. So my expectation is we probably have one more push down before gold should find some daily chart support. And as you can see, today was the 7th day from the most recent pivot high coming into the 50-period moving average. I would expect tomorrow, not necessarily expect, but I wouldn't be surprised, we'll leave it at that, that tomorrow we put in some kind of a trend change signal. Maybe a high volume reversal day, or maybe a doji candle. I've got my eye out, but that is my expectation. I think we will find some chart support in this zone, just slightly lower than we are now. We should have another leg higher in gold. It should be a powerful one. And at this stage of the game, and remember, let's go back. The last few weeks I was saying I would find it difficult to believe, or the last few sessions, when we got up to the highs, I was saying I would find it difficult to believe that we had enough mustard to get up to the $175 level or slightly above that, 1280, without some kind of a consolidation or pullback. Now we've gotten the pullback, and now the market has worked off some of the overbought condition and now can be poised to get up to and potentially through that level. We will get into the 13s this year. We should get to 13 and a quarter, maybe as high as 13.40 or 50 this year. That is my expectation in gold, but it's not going to be an easy track. It never is. It doesn't move in a straight line most of the time, and therefore it will have its fits and starts. But in my opinion, it is setting up for another leg higher with this pullback. How about silver? We're basically on the 382 in silver, and as you can see, we had another leg lower. We said the other day, when the market makes these big down moves like it did the other day, this one here, okay, that down move, this day here. When that happens, a move like that generally spells lower prices ahead, and that's what we saw. So my expectation also is to come in and tag the 50-period moving average on a hard sell. We may get down to the $17 area, but that would also provide a buying opportunity if we saw a signal or a trend change at hand. So that's what we've got our eye out for going forward, a sign of a trend change over the next day or so. That's what I'm watching for. All right? We could talk about GDX tonight, and GDX yesterday came up slightly short of a 618 retrace that comes in at 2130. Yesterday the low was 2135. Today we pierced through it, making a low of 2122 and reversing off that number, although not finishing all that great today with the down day in gold, not a big surprise. But we did put in, I guess you could call it a pseudo doji candle. It's a little bit outside of it. However, let's see if it holds. If we get any kind of a rally in GDX that may be a canary for the gold market, a lot of times we'll see GDX move ahead of the metal itself. So I'm watching out for that. We may have one more down day or potentially sideways day in GDX. But after that, I would be looking for a trend change. Why? From the most recent pivot high, today marks the 19th day down. 21 days is generally going to be a good marker for a trend change. While we haven't been down for 19 days in a row since the pivot high, it's been 19 days and another day or two, and I will be looking for a trend change in GDX. So coming into the 618, in the 19th day, tomorrow being the 20th day, we're looking for a change in trend in GDX. That's just the way it works. We may have another down leg, maybe we have a deeper retracement, but I'm looking for a turn forthcoming sooner than later in GDX. Those of you looking to get involved in GDX, this is your spot. Whether it's 50 cents lower from here or in this general neighborhood, this is your spot. If you're looking to get long GDX, you have to start thinking about it now. This is the area where most people are selling, and that's where you want to be a contrarian. And when they want to sell it, do them a favor and buy it from them. One's pain is generally someone else's pleasure. Remember, you have the Johnny-come-latelys, and the Johnny-come-latelys are buying it up here, okay? They're buying it here at the end of the run. And they're not necessarily sellers here, okay, because they're only down a little bit. So they're thinking that it's going to just take off to the upside again. But when they're over here, they're in pain, and they're in pain. And now they're really in pain, and they're going to throw it up pretty soon, and that's generally when you will see a trend change, when they capitulate out, and it's happening as we speak. The average individual investor or retail trader will generally buy at the highs and sell at the lows. That's just the way it works. Unfortunately, that's the way it's always worked, and that's the way it always will work. All right, next up, crude oil. still in the middle of the range, now making a bearish pattern. So we had this down move, and since the down move, and including the down move, this is day number 5. Whether or not we have another leg lower remains to be seen, but if it's going to happen, it will generally happen tomorrow or Thursday. And if that is going to happen, we'll most likely come into the 200 period moving average, which basically coincides with this pivot low from the 8th of February. And that would also provide a buyable or a buying opportunity for crude oil. But you have to see the sign of a trend change, maybe a high volume reversal, or some kind of a signal that it's a buying opportunity. You don't just buy willy-nilly, but there's a lot of support down here. 51.50 is support. There's a pivot low just above that. There's a 200 period moving average. That area would provide support for the market. Just let it play out. Very difficult to trade in the middle of a range, and that's where we remain. Let crude either fall or rally above 53.79. Before one of those two things happen, there's absolutely nothing to do. Heading over to the U.S. bond market. A little bit of trouble brewing in the bond market. As we speak, we're below the trend line. That's an important trend line. If we begin to trade below that trend line, there will be another leg lower in bonds. So it's make it or break it time. We started making a bearish pattern above that trend line, and you can see what's happening. It's starting to break the trend line even as I speak. Same thing as with crude oil. Nothing to do in the bond market today. We have to wait for a signal. We need to wait for either the bond market to hit an important price level, or we have to wait for the sign of a trend change, a high volume reversal day, or we need to rally up above the moving averages and close a day above the important number, which is 151.6. Until and unless those things happen, lower prices are expected in the short run for the bond market as we look at it here. And last up is the US dollar. No real change from yesterday. We remain above the moving averages, which does have a bullish bias to it. However, I still contend that this may be an ABC pattern developing for lower prices, the A leg, the B leg, and the C leg down to beneath the 200 period moving average. We're just going to wait for the dollar to give us more information. Right now, there's nothing to do. We're also, just like the crude oil market, we're in the middle of a range. So if you look at this as a low and this as a high, then we're smack in the middle of a range. So there's nothing to do in the middle of a range until we begin to get a breakout or a breakdown. If we get a breakdown, we're just going to let it fall, and we'll be able to pick up the dollar in this zone over here. And with that, folks, it's everything I intended to discuss tonight. Hopefully it's helpful. I'm David Frost. Thanks for tuning in for another episode of Common Sense Market Analysis.